You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everyone. Welcome back to the Infinite Banking Mastery Podcast. Am I too old for infinite banking? I do get asked this question pretty often, I would say. A lot of times people in their 60s or maybe late 50s are asking me this question. But certainly, no, you are not too old to do or to begin an infinite banking plan with a whole life policy. Even I helped my own father start a whole life policy at age 66. But I get people asking me if they're too old, even in their 40s and early 50s, or even sometimes in their late 30s. And for sure, certainly you are not too old to begin an infinite banking policy. Sometimes people will ask, well, I think I'm too old, so maybe I'll just write something on my children only or someone else because I think that I should have started much younger, or I wish I would have started much younger. Well, of course, we all wish we would have started much younger. Certainly I do as well. I wish that I would have started younger than I did. I found out myself about infinite banking while being a financial advisor and out there helping people already. I found out in my early 30s and immediately wished that I had known sooner and that I had begun policies sooner. That is actually a really common thing that I hear all the time. As soon as someone fully understands, and we've gone through all the lessons and the teachings and through the book and done a book review and just talked through all the concepts, people always tell me every single time, I wish I would have known of this sooner. It is just so common. I hear it every time from every person who reads and fully understands. And I get it because I also wish the same. But certainly that doesn't mean that when you get into your 40s, 50s, or even 60s, that you're too old for infinite banking. Even you can get a policy in your 70s. Now, most life insurance companies are not going to underwrite you past age 80 or 85. And of course, the policy will work and operate, will grow better if you start it younger because time is your greatest asset. And the longer you have your policy in force, it's going to have that time to build up and accumulate and snowball and accumulate with those dividends and interest all snowballing on each other and getting bigger. Although, of course, remember, infinite banking, the power of infinite banking really comes from you and what you're doing with the policy rather than letting the money sit and earn simply only the interest and dividends. It's you taking control of the banking function of your life and using that money to do other things, to go out and grow it in other ways and in other investments, to take over your debts from outside banks, and to take over really the financing portion of your life, taking over the banking function of your life. That's really where the power comes in. But of course, having the policy for a longer time period, when you're younger, yes, it will have more time as well to be able to grow. But still, when you're in your later years, you're still going to have financing needs. You're still going to want to maybe do some different types of investments where you could benefit from using your own pool of cash. And so it certainly can work for older people. It just may not be as growing as amazing as if you had started 50 years ago, right? But you still will have that control of your cash and you'll still have the growth of that. And then depending on how you feel about the life insurance component, that might be a big deal too, because of course you're going to leave a legacy to your loved ones. And so being able to build up that policy and fund it and use it and finance things you need. And then at the end of the day, being able to leave that legacy to your family while you were in control of your cash that whole time is a huge benefit for many people. Now, I will say that as soon as you do learn of this strategy, and maybe you've listened to podcasts or read some books or whatever learning that you've done, as soon as you've done that learning, it certainly is in your best interest to implement a policy sooner than later. I have a lot of people that reach out and they're studying and they're learning, and it's super great. And maybe they've told me, well, I've been learning about this for a year. Somebody told me to read this book 5 years ago and I didn't want to read it yet. Or I've been learning and listening to podcasts and I've read lots of books, but I still don't fully understand every moving part and how it all works. I would just say it's better to get started sooner than later. It's great that you have this thirst for knowledge. It's great that you're striving and doing your best to learn as much as possible. We absolutely do want you to understand as much as possible. When I help clients, I want them to know and understand everything that's happening as much as possible so that later on when they have a question or something, it'll be based on this foundation of understanding that they first had. However, if you're trying to become as knowledgeable as a practitioner, well, that might take a while. It's highly unlikely that you will get to a point of being as knowledgeable as your IBC practitioner specialist, simply because this is what we do all day, every day. We are helping people and we're helping people understand this. And so it's going to be hard for you to get to a point where you are able to teach it like we teach it and understand every little intricacy about it. So what you need to have is trust in your advisor, trust in the person helping you, and knowing that they know what they're doing. And then all along the way, once you have a policy in force and once you've got a plan in place, you should absolutely continue learning, continue reading, and continue growing in this journey. I would just say, I wouldn't wait to feel like you have all the knowledge before you begin, because that might take quite a while. And then all that time is wasted, and years again are your greatest asset. So you want to get things moving as soon as possible. You don't want to wait until you feel like you have finally achieved all the knowledge you need. Now, if we connect and I put together a plan for you to the best of my ability in your best interest with all of the things that worked out for you and the premium amount and the time frame, and just put it all together the best way possible, and for some reason it's not going to meet your goals or your needs, and you do happen to have somebody in your family or somebody that it makes sense to insure, then that certainly is an option. We can insure someone else. Oftentimes it will be a child, but then underwriting is getting a little more strict on insuring other people. They want to make sure there is an insurable interest for that. So last I was talking to an underwriter, they're saying, well, if your child has to be at least under 26 for us to find an insurable interest. Of course, there are reasons where you could have that insurable interest besides them just simply being your child or your children. However, if you don't have a specific reason that would make sense, then they would need to be younger than 26 in most cases. Also, sometimes people come to me wanting to insure grandchildren, which is a great idea. It's a helpful thing for the kids to have this pool of cash started off for them at the best possible ages when they're really young or newborn, and have the most potential, have their whole lifetime for it to grow and just take advantage of the most possible years. That is, of course, a true gift. But when you're doing that as well, there are some guidelines. You're going to have the parents will have to have insurance, or you're going to have them insured, or they're going to have to already have insurance or acquire insurance. That usually you can't cover the grandchildren without the parents having coverage. The grandchildren or the children have to have no more than about half of what the parents have in force. And so there are some details around that as well, but that's kind of generally how it works, that they can't have more than half of the parent with the greatest amount of coverage. And so the parents then would have to have coverage in place, even if that's just some term insurance or whatever. We're going to have to put something in place in order to insure the grandchildren. Sometimes they do already have something in place and it works out just fine. Of course, if you have a business or something like that, you want to put a key man policy on someone or some sort of business structured policy for an employee, then that's another person that you could insure, although generally that is something that you're going to be bonusing or benefiting that employee with over time or at their retirement. Sometimes if a person is much older, a way to help the policy grow with cash or grow the cash more efficiently, if that's really the primary goal, we could shorten the time period, the payment time period. Now, again, it doesn't work for all people. That's not always the best solution for all people because it really depends on the goals of the policy. But one way that's possible to get the cash to grow more efficiently would be to shorten that time period so you're not continuing to pay into your 90s, basically. However, of course, any time that you shorten the time frame on paying a policy, it's oftentimes likely to have less cash because you're putting less cash in because you're stopping the payment. Whereas if you continue, it's going to continue building with the cash that you're adding to it. So oftentimes when you're shortening the time, it will grow very efficient. It will grow well. It just will end up as comparison to a policy that continues to have premium may have less cash in the long run because you've put less in. So again, just depends on the age of the person, the health rating, and what makes sense and what the goals of the policy are. And is death benefit actually something you want to leave behind? You want to leave your loved ones a legacy and take care of them or just love them in that way when you pass on? That's all a part of the planning to make sure we're building a contract that is fitting for you, is going to work for you, and is going to allow you to begin your banking system in the best way possible. So speaking of shortening that payment time period, another option that sometimes people use when they have a large lump sum of cash and they're older, and doesn't necessarily mean they're older all the time, but just more common maybe for an older person who needs to store cash somewhere. Sometimes they will want to move forward with a single premium policy. That's a one-time payment. And so those can be built very efficient as well so that the cash can grow as efficient as possible and they will grow very well. The only thing with that policy structure is that it is a guaranteed MEC. It's 100% going to MEC every single time. And so if keeping your funds income tax free is your major goal or a priority or one of your main goals, that would not be a way to go. But it does sometimes work out for people who need to store cash somewhere, who want to have access to cash, who wants it to be guaranteed to grow, who wants to leave a larger legacy. Sometimes a single premium policy would work out if taxation is not the main issue, is not something that they are concerned with. So really, at the end of the day, infinite banking, a big part of it is about being in control of your capital. And so how long do you want to be in control of your capital? And what age do you feel you no longer need to be in control of your capital? That's the question. So if you like the idea of being in control of your capital and you want to look into this strategy for yourself, you absolutely should. Don't worry about the age. Just get together with someone and work it out. And then if it really doesn't work out for you because of one thing or another, or even health restrictions, you certainly could look into possibilities of insuring someone else. Well, that's all I have for you today. If you think I would be a good fit for you, if you would like to work together, please reach out to me at Valerie@alphaomegawealth.com. I hope you enjoyed this episode that was helpful to you in some way, and I hope you have a great week. Talk to you next time.
This is thepodcastfactory.com.